See, securitization is a process of converting illiquid assets into liquid assets. This is also called as crystallization. Liquid assets in the form of marketable asset-backed securities. Okay, I can say MBS. Marketable asset-backed securities. See what happens. Banks give loans to people. Am I right?
Yes, sir.
But they get money in form of deposits. Deposits are like $2,000, $1,000, very small amounts. Some people may deposit 10,000 in a day. For example, see, you can't expect all the people depositing their money in the bankers, the big companies. So if they get money in current account, they withdraw it immediately because they need to meet up their daily expenses. Savings is done by the people who earn money from the business or like transactions. I mean, say very less amount goes into the bank in form of deposits, but loans go in for loans are very high amounts. So suppose I want a loan to buy house. It's like $1 million. So $1 million is a big amount. So let's take India's perspective. If someone is depositing 5,000 rupee, someone is depositing 10,000 rupee, but the loan what someone wants is 1 crore rupees for buying an apartment. In Hyderabad the rates are skyrocketing now. 5,000, 10,000 rupees per SFT, 12,000 rupees per SFT near Kokapet and all high tech city. You won't find any flat less than these amounts. Okay, everywhere it's skyrocketing now. So the loans are very big amounts, but the deposits are very small. So what do banks do? Banks to give loans, bank take the property title deeds. Am I right? They just get all the title deeds. That means if you want to take a bank loan, if your flat costs 1 CR, then 20 lakhs is your equity and 80 lakhs is debt given by the bank. Okay, so for that debt they want your property title deeds as security, because without securities you can't expect a loan from bank. If you default, then what? So these securities are piled up with the bank. They have lot many securities. Now what will they do with this? What will they do with this? These securities, these properties title deeds what the bank has, bank will convert them into mortgage backed securities. That means they will convert them into bonds. So suppose these have a valuation of 100 crore. These all securities are 100 crores securities. So they'll convert 100 crore. These all property title deeds what bank has as securities value 100 crores. So bank will convert these 100 crores into $1,000 or rupees or whatever denominated bonds, sell to public. Okay, and raise funds from there, and then use those funds to give more loans to the needy people. Am I right? And whatever the EMIs they pay, okay, these EMIs are passed on to these people who have taken the bonds. So this is what is the general concept here I have given. So what I mean to convey with securitization is bank converting the property title deeds into securities or bonds. Okay, and I'm not mentioning anything like special purpose vehicle and all. I don't want, because you can go through the detailed process in the video, because that much is not required for you. What is required for you to know is bank converting all these title deeds what they got as mortgages into bonds or securities, selling it to investors, raising funds from them, using that to give further loans to people who require loans. Okay, because they get very less amount in form of deposits. So this is the alternative bank has. This is called originate to distribute model. Now you check the video today. Okay, I think, did we do international money markets yesterday? Hello.
So you were going to begin from the euro currency markets and everything.
Okay, from here I have to go ahead.
Yeah.
Okay. euro currency markets are nothing but if you want to raise loan for your business, you can do it by raising it from some other countries in international currencies. That is called euro currency loan. Okay, so that is also a available alternative you have. So when a company borrows in foreign currency, the loan is euro currency loan. So UK company borrows this much dollars from its bank. So the loan is taken by the, excuse me. Hello. Hello.
Yes.
Okay. Now, okay. Plasma is very much required this time. Now, so I think you got the, for example, UK company borrows. See, UK company which is placed in UK, maybe in London, Birmingham, anywhere. That's like all right. They can approach a bank in their own country and take it in dollars. That's euro dollar loan or euro currency loan. Fine. So, like euro currency markets involve the depositing of funds with bank outside the country of the currency. So euro currency markets involve what? Depositing. So these are the markets whereby it involves depositing of funds with bank outside the country of the currency in which the funds are denominated and relending these funds for a fairly short term, typically 3 months. So you can deposit your money in some other bank outside your country, and whenever you want you can take loan. Okay, so most euro currency transactions in fact take place between banks of different countries and take the form of negotiable certificates of deposit. So they trade in certificate of deposit, they keep like that, they keep this security there, take dollars and then repay back and get their securities back. So this happens in that way. International bond markets is nothing but if a company, suppose ABC company, wants to raise money, that means they have to issue bonds to public. So they issue these bonds to international investors and they get money. Okay, fine. So that way they are raising funds. Fine. Now, large companies may arrange borrowing facilities from their bank in the form of bank loans or bank overdrafts. Fine. There are very big companies, they want loans, they can take the loan from bank or they can take OD. Alternatively, they may prefer to borrow from private investors, which I said they are issuing bonds to public. Other words, instead of obtaining this much bank loan, company might issue bonds in order to directly borrow from the investors. So that is what, if they do it from the international investors, it is kind of international bond markets. Now you don't have details of what kind of markets are there and all. So for example, if there's an Indian company, they want funds in form of dollars. So what they can do, they can get a tie-up from a United States bank. Okay, and there these guys can give them the securities which are issued as ADRs, American Depository Receipts, to the United States investors. Money is again from there comes to the bank, and that money goes to the Indian company, and from here whatever the returns what they generate, they pay the interest to these people. Okay, so this happens in that way. American Depository Receipts. See why people go internationally. If they don't get finance in their company, in their country, if they don't get enough finance or enough capital in their country, definitely they would approach international markets for arranging loans for them. Okay, or arranging funds for their usage. So if there is a company, Tata, and Tata is not getting enough funding in India, they can approach international markets for that funding. Now rates of interest and rates of return. See, pattern of interest rates. See, interest rates are not a new term for you, correct? So what is the interest rate if you want to borrow money, or like or like kind of bank has to lend money to you, bank will charge some interest. Why they charge interest? See, if this is Mr. A, this is Mr. B. Mr. A kind of is in need of money. So Mr. A doesn't have those funds. So Mr. A can approach Mr. B. Mr. B has surplus cash. What Mr. B says, okay, I'll just give you money. You can borrow it from me. Whenever you are in need, you can borrow. But since I'm giving my money to you, and what guarantee I have that you will like repay me? So for that reason, he takes some gold, okay, as a collateral. But instead, he also says this gold is what you're going to get in return from me. Okay, because this is just a security you have like put with me for getting money from me or for borrowing. This I need to return back when you return my money back. So security to security exchange. But since there is a risk involved in all this, I would penalize you. That means I'll charge interest from you for whatever the money you have taken from me as a borrowing. Okay, because that fine day, if the gold prices drop, if that day, that means after 1 year, when the maturity of this particular loan comes, and on that day if I go and sell this gold and I don't get the value what I'm getting today, I'm in losses. So that gold's price fluctuation risk, inflation in the market, and yourself defaulting my money, and lot of factors are there, lot of risk is involved. So to compensate for that risk, I would charge some interest from you. Okay, that is what is the concept of interest. Fine. So bank also charge interest on us. Fine. So now see, interest on financial assets are influenced by risk of assets. See, if you want to take loan from bank, so bank can give you personal loan of 1 lakh without charging, without taking any document as security. Why? Because seeing your profile, past profile, your earning capacity, they are giving you 1 lakh rupees loan. So the security what they have taken with them is your earning capacity. If you want a 50 lakh rupees loan, they'll ask you what? Property documents. Correct? Why? Because for such a big money, they want some security. But now what they will charge, the interest what they will charge. See, I said you why they charge interest, because here also this guy has taken gold, but gold is only a security which this guy has to give back to this borrower on the date of maturity. Fine. But if this borrower does not make the payment, the lender has the right of lien. That means he can sell the gold and get his money back. But you know, on that day, if the gold prices go down, and if doesn't get a buyer to sell this, and if it takes like 5 to 6 months or 1 year to sell this gold, then he is incurring losses. So to compensate him for all those risks, he is charging interest. Now, so the interest charged by this lender would depend upon the asset. So how liquid the asset is, how highly liquid the asset is, that much less interest would be charged. If it is gold, suppose the interest is charging is 5%. If this is not gold, suppose it's land, he'll charge 8%, because land would take much time to sell and recover the money, as well as land is not highly liquid. Okay, so it depends upon the risk characteristics what the asset carry, the interest is charged accordingly. And also duration, the higher the duration, that means if you take loan for 2 years, definitely the interest would be less. If you take loan for 10 years, interest would be high. If you take loan for 30 years, interest would be even more high. Why? Because the duration is very long. Since the duration is very long, the higher the duration, the more the interest charge, because the more the risk. Okay, are you following?
Yes, sir.
Yes.
Risk, there's a trade-off between risk and return. The higher the risk what you have from the borrower side, the higher the interest you will charge. If the borrower's profile is not that good, so if there's Mr. A and Mr. B who has approached a bank for a housing loan. So interest charged to Mr. A is 7.8 and interest charged to B is 7. Now these people meet in the evening and they argue, what is this? Bank is so partial. But no, bank is fair enough. Why? Because the risk is high on Mr. A. Okay, he has defaulted maybe previous past, and he's for example, is not default, he's a businessman, and there's no consistency which can be expected from this guy. Ups and downs happen, am I right? But B is a salaried employee, since 20 years he's working, like stable, his profile is a stable profile, so less interest. Need to make a profit on re-lending. See, banks take money from people for 5% and they give a 10 or 11% to people. So they take money and they kind of relend. Am I right? Duration, I have explained you. The term of the loan or asset will affect the rate of interest charged on it. In general, longer dated assets will have higher yield than smaller dated assets. So the differences, so that's what, if it's longer time period, the interest charge would be high. Okay. Size of loan or deposit. If you take a higher amount loan, the interest would be like high. And if you take a small loan, okay, why? Because the money is lent to you is a bigger amount. Fine. So if it's a bigger amount, the risk is high to the bank and they charge high interest rates. So a 30-year loan would have a high interest rate, and a 1 crore, see, 1 crore rupees if you take, it will be having a higher interest rate. For example, you go and approach a bank, do a practical this thing. If you take 30 lakh loan, they'll give you 6.5, they'll charge 6.5% as per the housing loan interest in this slab, 30 or below 30. Above 30 to 75, they'll say we'll charge 7%. And above 75, if you're taking 75 to 1.5 crore, they'll charge 8% because the amount is increasing, the risk is increasing. Now, different types of financial asset, I have already told you, like different assets have attract different kind of interest rates based upon the risk characteristics. And the rate of interest paid on government borrowing provide benchmarks for interest rates. For example, excuse me. So clearing banks might, so what is that? The rate of interest paid on government borrowing provide benchmarks for interest rates. See, now there'll be a question from your part. See, how are these interest rates decided? How the bank decides the interest rate? Because bank has charged 10% to me, he has charged 12% to my friend. So they can charge whatever they want based upon the risk characteristics, but they will start from a benchmark. That benchmark is nothing but equivalent to the government charging or government paying to the investors on government bonds. Okay, below this the bank will never charge. That means if you take any loans, the interest charged by a bank would be higher than the government bonds. That means what government is paying to its investors, what government is paying to its investors for raising money from them. So how the government has raised money? Government has issued bonds to the people and raised money from them. So now government has to pay interest to the people or investors. So government is paying suppose 7%. So banks will charge definitely more than this, never less than this, because the risk is very much high on loans when compared to the government bonds, when compared to government borrowing from people. Okay. So I said there is a trade-off between risk and return. The higher the risk, the higher the return you should expect. Less the risk, the less the returns you should expect. Here they have given uh, government bonds, very less risk. Company, somewhat more than government. Okay, but less than the preferred stock. Then third number is preferred stock. This is the hierarchy. This is the least risky asset. So after that comes the company bonds, because bonds are liabilities for the government as well as for the company. So before paying the due share to the shareholders, first they need to repay, or they need to fulfill their obligations, their promises towards their creditors. So first they would pay the interest whatever is there to the bond holders, and after that leftover profits, you know this is like your sales less COGS, you get gross profit less selling, administration, and operating expenses, you get operating profit. I can say this as EBIT. Okay, so this is what you've got. So this is what is the operating profit. But like from this, if I just deduct the interest, I get the EBT. Then I remove the tax, then I get EAT, earning after tax. Then if I remove the preference dividend, I get income available for common shareholders, correct? So what is happening here? First they have to meet this obligation, then this. So the first the people who are supposed to get their due share is the bondholders. These people are creditors. If the company doesn't make the payment to them, they can sue the company in the court of law, and since the company has issued them asset backed security, okay, that means government if government issues bonds to people, see, you have a 100 rupees currency note. So what is the value of this? You give this note to some African, some European, they'll throw it away. They'll say this is a stupid paper for us. Why? Because this carries the promise made by the Reserve Bank governor to the people who are holding this, that they will make the payment of this. Since this has the security of the apex bank of our country, this is a bill or a bond or a security for us, correct? In the same way, the company issuing bonds or the government issuing bonds will have the backup of the government and company's assets. So that becomes a valuable paper for us. So if company does not make, we will sue the company, we'll drag them to the court of law, and the court, what the court will do? The court would order the company to make the payment or sell the assets and give the money to the investors. Am I right? Excuse me, I'm having a lot of calls today. Excuse me. Then comes the turn of preference shareholders. These are the owners. So then these guys take a higher risk. And then since these are the actual and original owners of the company, they have to bear the maximum risk, and after meeting all obligations, they would get the returns. So since the risk is high, the returns would be high. So how the return pattern would be: if government bonds are giving 7%, company bonds will give 9%, preference stock would get 10%, and ordinary shares would get 14%. That is the way they go, because the risk is high. What is reverse yield gap? See, stocks, shares should get 14%. Am I right? Because the risk is high. But if and bonds should get how much? Let us take 10%. This is a normal risk and return trade-off thing. High the risk, high the returns. Somewhat lesser than this, less returns. But sometimes bonds would pay 14% and stocks would pay 10%. This is called reverse yield gap. Okay, that should not happen, but if it happens, it's a reverse yield gap. Now, so interest and shareholders returns. Given that equity shares and interest bearing investments stand as alternatives, yeah, because you have equity and bonds to invest. So changes in the general level of interest rates can be expected to have effect on the rates of return which shareholders will expect. If in an economy the interest rates would go up, the equity returns would also go up. That is a understood fact. Okay, interest rates going up is nothing but indication inflation is high. So in an inflated economy, you will not settle yourself with less returns. You will want a higher returns. Okay, so if the return expected by investor from equity investment is 11%, dividend paid on shares is 15 cents every year, the market value of one share will be 15 cents by 11%, this one. Okay, and yeah, because you know, this is the, if you want the share price, if you want to find out the share price, the formula is what is that they given? Dividend by cost of equity. So if I take the cost of equity here, okay, fine, this is the formula, share price. So this is the share price now you have, but you know, interest on debt instruments fall. Okay, let's see. Equity shares and interest bearing investments stand as alternatives from investors' point of view. Changes in general level of interest rates can be expected to have an effect on rates of return which shareholders will expect. So here the interest rate is 11% and here the interest rate is 9%. So if the return expected by an investor from equity investment is 11%, so KE is 11%. That is what is the required rate of return a equity holder would Want. KE means return on equity. And the dividend, so you got the share price. Now, next question. Suppose that interest rates on debt instruments then fall. Suppose the KE, the cost of equity, that means the return on equity is 11% you're expecting, but the interest rates have fallen in the market. The options of putting funds on deposit has become less attractive. Yes, why? Because the interest rates have fallen. People don't want to invest their money in bonds. Okay. As a result, the shareholders' required return may also fall, say 9%. Then the market value, see, as the KE, as the returns are going down, the share value would go up. Why? Because investors would want to invest less in bonds. They'll shift their much more focus on equity. Am I right? So see, the price has gone up. So what they're saying is, increase in the shareholders required rate of return will lead to fall in market value of shares. But why? See, a general logic, very simple logic, I would say. This 11% and 9%, this is a discount factor. This is a discount factor. The higher the discount rate, the less the value. The lesser the discount rate, the higher the value. That's it. You got it now what I'm saying, the logic?
So I don't
Hello.
understand. Like it's the required rate of return. Yeah, when it's the rate of return, if it's falling, then how will the market value increase?
See, what is the share price formula? So previously, what was the dividends, what they were giving?
15 cents.
15 cents.
Yeah.
So dividend by 11% is what you got, 1.36 share
Yeah.
price. Now, what is the dividends these guys are giving? These guys are not, there's no dividend. Am I right?
Yeah.
What has happened is, the option of putting funds on deposit has become less attractive, and result shareholders required return may also fall. See, the returns have fallen now. Why the returns have fallen? The interest on debt investments have fallen.
Okay.
Since the interest on debt investments have fallen, people started, option of putting funds on deposit becomes less attractive, as a result shareholders required return may also fall to 9. Then the market value of one share, you see that an increase in shareholders required rate of return, because in the market value of the share, this point is not pretty clear here. Just let us see an example. Interest rates are falling. So what would people do is, people won't deposit more. Since people won't deposit more, they will put more money into the other investments.
Yeah.
Since they put their money more in other investments, interest rates on debt investments then fall. Option of putting funds on deposit has become less attractive. Yes. So what is happening is, the, suppose here the interest on debt invest, suppose the interest on debt investments was 10%, it's gone to 8%. Because I know there is an inverse relationship between the yield and the bond price, but here they are speaking about equity. Just 2 minutes, wait, I'll tell.
Yeah.
See, what I know about the bonds is, if the interest is 10%, okay, that has fallen to 8%. So what will happen? You don't want to hold your bond, correct?
Yeah.
Since you don't want to hold your bond, you want to sell it in the market. Can you sell at a higher price or lower price?
Lower.
Common sense, because the interest rates have
Interest
gone
rates have
down,
gone.
no one would take at a higher price.
Yeah.
Okay, so your bond value will fall, and if the interest rate goes up to say 12%, so so when interest rates fall down, okay, just hold on. See, your company in which you have invested is paying how much?
10%.
Coupon. What is the market interest rate?
8%.
So since the market interest rate has fallen, your company is paying high, you would sell at a higher price or lower price,
A higher one, okay, yeah.
bond value increases. If the interest rates go to 12% and your company is still paying 12%, your bond will go at a.
Lower price. Okay.
Now let's see what they're saying. Suppose interest rates. So interest rates have fallen, na?
Yeah.
So option of putting the funds on deposit has become less attractive, and they are looking for some other alternative investments. So when the interest rates fall down, what is happening? The securities value is increasing or decreasing?
I didn't get your question, sir.
See, this was the company paying the interest.
Yeah.
Market interest rates have gone to.
8%.
So someone approached you. The people, see, you are holding a bond which is promising 10% returns.
Yeah.
And in market, the interest rates have gone down to 8%. So some of your friend came and told you, since you hold that bond now, why don't you sell it to me? I am in need. I just want to buy the bond. If you are willing and ready, you just sell it to me.
Yeah.
So what will you say? See, right now in the market, the interest rates are 8%. My bond is paying 10%. If you take any bond in the market right now, it is paying 8%. But my company, when I bought the bond 5 years back or 2 years back, for example, they at that time the interest rates were 10%. So now your bond is in high demand, correct?
Yeah.
You will charge less or high?
High.
This is understood fact. Higher price.
Yes, sir.
Because when your friend will purchase the bond from you, he will get a higher interest rate, na?
Yeah. More
So
than the
to
market.
compensate for that, you'll charge high. And
Yeah.
when the interest rates go up, now you are in like catch situation. You don't want this bond to hold. You want to sell it off.
Yeah.
So, but when you want to sell it off, no one is ready to pay you a higher price. So you have to sell it.
Lower
It's a
price.
demand supply game.
Yeah.
So since the interest rates have fallen, the prices would go up for some other securities, correct?
Yeah.
Because the demand for other securities will rise.
Yeah.
When the interest rates have gone down, the demand for stocks would go up or down.
It should go
It should go
up.
up, correct?
No, yeah, up, yeah.
So here the investors required rate of return was this. Now the returns have fallen. So now, since the returns have fallen, the bond value has gone down. For example, you would want some other securities to buy. So so if you want to shift yourself to other securities, they'll charge higher amount from you. Correct?
Yeah.
That is what is the concept which I know. But these guys have not framed the things properly. So did you understand the demand supply logic?
Yeah.
Or you want me to explain clearly here once again?
No, sir, understood.
No, sir.
No, there's nothing like I can explain once again. No problem. You want?
No, sir, clear.
Okay, good. So interest bearing instruments are these: money market deposit, certificate of deposit, repo, and so money market deposits are nothing but short term investments for short span of time. Certificate of deposit is also you deposited your money, so you get a certificate for that and you get returns on that. Repurchase agreement is nothing but here is a bank. This is you want to you have booked a flat. 50 lakh is the cost, 10 lakh is your equity, 40 lakh is your debt, and here is what you made the down payment for that, and the debt was given by the bank. So bank has asked you to deposit the title deeds with them, mortgage. So what I am seeing here is kind of like this is kind of a sale, correct? This is what you're buying a loan, am I right?
Yeah.
You're buying a loan, you're buying a debt. So to buy, what you're giving to them? Property, title deeds. So the loan you've bought for 40 lakhs. And So this is what the cash is given. Now when you again want your property back, okay, you would repay them 50 lakhs, you get your property back. It's a repurchase, correct?
Yeah.
So that's a repurchase agreement between you and bank. Discount instruments is nothing but they won't give you 100% on those securities. So treasury bill, this is the United States like government security. Never ever the United States government has defaulted any time till in the history of United States on this. The most secured one. All the black money what goes to Swiss bank, the Swiss bank keeps that black money of all the rich people who make their money through by not paying taxes to government and by all the malpractices. They just transfer their money to the Swiss bank. What this Swiss bank does is it pays zero interest to those people, but the amount is converted into dollars, and that dollars they purchase the treasury bills of United States. This is the most secured investment, and on this they earn interest. So the money is coming from all the rich people to Swiss bank. Swiss bank is investing in treasury bills, getting interest, enjoying the interest, and the Swiss economy is always booming. Bankers acceptance is what bank, the bills of exchange kind of commercial paper is like securities in issued by the commercial companies for 270 days, raising funds by with the help of these kind of bonds. Okay, but this is not an asset backed security, let me tell you. Okay, some big companies like Tata, whereby people trust them, they have a legacy, they issue these kind of securities. And then derivative derives its value from the underlying assets. So forwards, futures, don't worry, see, I will give you some videos for this. Leave it right now. But what are derivatives? Do you have any idea about derivatives?
No.
To agree to buy or sell something at a fixed price.
So let's take an example. So see, for every transaction there should be a buyer, seller, and there should be some sentiments. So buyer has, like, there are two types of people in the market. One is like a speculator, one is a hedger. This guy has a bullish sentiments. He thinks that the prices would go up and I would enjoy. I People, they put a lot of money on betting and all these kind of things, like they play in casinos and all. These are not hidden facts. Every day or three you see in Times of India people caught for betting and all. Gambling they do. These kind of people, they always want to make money with increase with with their money put with some money invested in something, and that value would go up and they would enjoy with that value what they are getting, higher value, okay, for their investment. Hedger has a bearish sentiment. I'll take a very good example. So bearish sentiment is, these guys always worried about the minimum price what he should get. For example, if this guy is a baker or a biscuit manufacturer, so this guy wants the wheat. This guy has a wheat flour mill also. They make a wheat flour. They make wheat flour, and that wheat flour they use for their baking. So these guys are worried that the wheat prices would go up. A small example. Okay, here they don't want to. Here the thing is, these guys, since I've taken a speculator example, the people who are speculators would always like to enjoy when the prices go up on their investments. They want to buy at lower rates, and if it goes up to 150, they want to sell at higher rates. So they buy at 100, sell at 150. They wait for the right time when the prices of what they have bought goes up. Suppose this is SBI stock. SBI stock bought at 100. If it goes to 150, these guys want to make profits from that. So they bought at 100, they'll sell at 150, and they get a 50 rupees profit. So what I mean to say here is, in my example, these bakers are, they want to, like, these guys like know that the wheat prices right now is 100 rupees per bag. Okay, they want 10 bags, so 1000 rupees is what it's costing right now. So they think the prices would go up in the future, and if the prices would go up, they'd get a, in 3 months they want to manufacture, they will get a, or they'll manufacture after 3 months. Okay, the biscuits, for example, they want to manufacture after 3 months, because right now whatever the wheat they are getting in the market is of not good quality. They know the new harvest season would come and the wheat prices would shoot up, and good quality of wheat can be available after 3 months. So they don't want bad quality wheat even though sold at cheaper rates, because that would not give a good quality biscuit. They don't want a compromise on their quality, so they want high quality wheat. They want to wait for 3 months, they want to buy after 3 months, and they are worried after 3 months the demand for that would be very high and the prices would go up. Hedger has his own sentiments. He says right now it's 100 rupees per bag. After that, the prices of wheat would go down. For example, even though it's of high quality, he's worried from his own perspective. He's a farmer. Farmers always struggle to get the minimum price. Okay, they always want the minimum price. So the farmer sees that today the bag is of 100, and in future, today the wheat price per bag is 100, in future it will go for 90. So speculator and farmer, they meet, and what hedger says, I want to make a contract with you because these guys dependent on these people and these people are dependent on these people. So hedger says, I want to make a forward agreement with you, forward contract. I want to make a, what is this?
Forward contract.
I want to make a forward contract with you, as per which I would sell you 100 bags, 10 bags of wheat at the rate of 100 bag each. And the speculator is also happy. He says, fine, I am ready to pay you that, because he thinks the prices would shoot up, it would go up. If the prices go up, then his biscuits would be costly in the market, and if he is not coming to this contract, there are many other biscuit manufacturers who would have made this contract already, and they may take advantage in the market because they are going to get the wheat at cheaper rates because of the forward contract. So with this, what has happened, both of them agreed for this, and the farmer has hedged his risk, because if the prices of the wheat go down to 70, then also he is going to sell at 100, correct? Because they locked in the price, correct or wrong?
Yeah.
It's a contract, no? They locked in the price. And if it goes 70, then also speculator has no problem, because for him the prices going down is not an issue, the prices going up was an issue. Am I right? So
Yes.
in any case, one party's gain is one party's loss. If it goes 120 even, then farmer would think I did a big mistake, but no, because if it goes down, then he would have a problem. If it goes up, if it goes up, farmer has a problem. If it goes down, speculator has a problem, because he would also think that he paid a higher amount. But here in forward contract, they knew all these conditions and then they made this contract. So the price is locked in, and after 3 months the price has gone to 120, but still the speculator pay how much?
100 only.
100. That's what. Okay, so this is what is the forward contract example of derivative. I have n number of examples, but that is not required right now. Okay, so I think this repo is covered, so you can do this repo. Treasury bills is covered. This is for 91 days. This is for 270 days. Commercial paper is covered. Let's do the other things tomorrow, and futures. Tomorrow I will wind up this chapter. Okay. Tomorrow I'm going to take a class for you. 5:30. Be ready. Hello.
Yes, sir.
Okay. Yeah.
So the test tomorrow, it's like for 1 and 2 or 1, 2, 3?
If 1 and 2,
1 and 2 only. Right?
yeah,
Okay.
1 and 2 chapters, okay?
Yes, sir.